My name is Mushir Ahmed. As Daniel mentioned, I'm the founding member and general manager of the FinTech Association. The FinTech Association is an industry body that represents large corporates to startups in FinTech in Hong Kong, and we work very closely with regulators as well as various players on different aspects of FinTech, including on regulations and developing best practices for blockchain and crypto. With us today, we have three very distinguished panelists. What I'll do is I'll let them do a quick introduction about what their current role is and their interest in digital assets, starting with Ms. Benedict Nolens. Benedict?
So hi, I'm the head of regulatory affairs for Circle. Circle is an OTC trading platform for crypto, as well as an exchange. We also have a stable coin called USDC, and in addition to that, we also have an investment app. So that's my Circle role. But I'm actually also here in another capacity. I'm also part of something called Global Digital Finance, which is a pro bono effort to actually create standards for this sector.
Dave?
Yeah. Hey, thanks, Mushir. My name is Dave Chapman. I'm the executive director of BC Group. It's a main board listed Hong Kong Stock Exchange company. We have 300 employees globally, and we focus on providing easy access to digital assets, but predominantly on the institutional side. So we operate a very large OTC or digital asset brokerage firm called OSL, and we also operate an institutional exchange along with white label technology called ANX1.
Hi, I'm Yoni Assi. I'm the CEO and founder of eToro, the world's largest social trading network, where we have over 10 million registered users who can trade stocks, commodities, indices, currencies, and cryptocurrencies, and everyone can see, follow, and automatically copy the top traders in the network.
Perfect. So, three different backgrounds, and we're all invested in some sense in the digital asset world. Now, we've seen a lot of volatility as well as a lot of changes in the digital asset / crypto world in the last 2 years, from Bitcoin touching a high of close to 20,000 in December 2017 to the crash of last year and fall to almost 3,000. But the year has started a little rough in the stock market side. Crypto has been there or thereabouts, but where do you see the overall digital asset management world as it stands today? So I'll start with Dave, sure, and we can move on with Yoni and Benedict after that.
Yeah, sure. So for some context for this question, my background was investment banking, and I discovered Bitcoin in 2012. And subsequently left and started working in the digital asset and blockchain space in 2013. And it's interesting to note that in 2013, traditional finance thought that Bitcoin was a joke. It was magical internet money, it was a fad, it was Ponzi, it wasn't here to last, and it was dismissed for a large number of years. And then what we saw is, financial institutions took note of this new blockchain technology and still dismissed these public blockchains, i.e. Bitcoin and whatnot. It's only really now, probably the last 18 months, when traditional finance have now acknowledged that it's not a Ponzi, it's not a fad, and it's not going away. And whilst traditional finance might not like what this asset class represents, the fact that they've acknowledged it's not going away, they now want to know how they can make money out of this. And so the institutional interest in this is peaking, maybe not because they want to, but because they are being disrupted and they acknowledge the fact they have to be engaged. And so we'll talk later on about some of the things that are still creating barriers for institutional interest. But I think there's still, throughout the continuation of last year, despite an 85% correction in the total market cap of this crypto asset class, the reality is this was the first correction, of which we've seen many, where institutional, or the traditional finance world was still investing a large amount of money and capital around infrastructure, waiting for this, either the next bull run or just actually accepting the fact that adoption is going to increase.
You're from Israel, but you also get to see what's happening in Europe and potentially in the United States. Having founded eToro's social trading platform, right, and getting into crypto, what was the motivation behind that, and where are you seeing that growth in your clients at this stage?
So the vision of eToro was to open the global markets for everyone to trade and invest in a simple and transparent way. And that's also why sort of the crypto industry really inspired us because I think it represents a big part of our vision to open the global markets. We're actually launching this quarter in the US, so traditionally our business is very much focused on Europe. We started expanding into Asia over the past 3 years. We have a large team in Shanghai. And generally what we've seen in eToro, we've actually seen sort of, we've very much enjoyed the crypto mania. We saw in one day more about almost 30,000 new funded accounts in one day in 2017, which was mind-blowing. The walls almost collapsed in our office. But I think right now what we're seeing is a lot of the people who came into crypto to eToro are still hodling their crypto, so that's very interesting. We see the number of units of Bitcoin and XRP and Ethereum roughly stable. So the value went down, but the amounts of units are roughly the same. And we're actually able to sort of convert them into investing in other asset classes. So I would generally view sort of two parts. One is cryptocurrencies as an asset class. And I think it's a very interesting asset class. It's a generational asset class. It's a very Generation Y type asset class. And then on the other hand, there's blockchain as infrastructure for financial services, where stable coins, I think, represent something very interesting, sort of enabling financial institutions to share their balance sheet and transfer their balance sheet from one institution to another. So we're looking at sort of how do we transform our entire infrastructure to be blockchain based in the next 2 years.
Okay. That's the whole transformation that's happening. Now, Benedict, you've had a very distinguished career in investment banking, and you were then with the regulators, and now you're working for Circle, which in some sense is a fairly new startup. It has had roots, but why the change, and what do you see in terms of the institutional interest in crypto from a Circle perspective?
So I think we all have seen the same, very high volumes, and let's say these volumes were definitely the highest, I guess, towards the end of 2017 and then the first half of 2018. Now, in terms of institutional, I think it has a different meaning for a regulator than it has for maybe this panel. So for a regulator, institutional is typically a licensed financial institution or a licensed asset manager. Whereas within this space, when people talk about institutional, in fact, they often talk about very large traders. So on the OTC desk, for example, the trades are typically over 200,000 US dollars. So definitely they're big trades. But it's not the same as the definition of institutional in a regulatory sense. It's not necessarily a licensed institution. So let's say that whole ecosystem, as Dave was also saying, exists. There is a lot of people that took big positions early on and made a lot of money. There was also, of course, all the ICOs that raised money and that sold through large OTC desks. Of course, there has been, over the last few months, regulatory uncertainty, you could say. And I think that the crypto markets are actually a good example of how regulatory uncertainty can actually impact volumes quite a bit. So then the question is, are we moving from regulatory uncertainty to a bit more regulatory certainty? And I personally am optimistic on that. I see more and more regulators at least taking a stance. So let's say in Hong Kong, the regulator has taken a stance. It's issued a series of circulars whereby it said licensed asset managers can invest up to 10% in crypto without needing SFC approval. So with that, it was de facto not damning crypto, and in fact saying you can invest up to 10% without needing to go to the SFC and ask for it. Secondly, it also came out. They also came out with another circular where they open up a sandbox option for people who want to limit their business to institutional clients, or actually lower than institutional, to professional investors and above. And a PI in Hong Kong is typically someone with liquid assets of around 8 million Hong Kong dollars. So that option is on the table. They also, by the same token, you could say, said in that circular that unless platforms want to comply with these restrictions, then unless they do that, they won't get a license. Inversely, that means they can stay unlicensed. So there's two options in that regard. And then let's say Hong Kong was only one of the markets. Singapore recently came out with regulations around payment services. And Europe has come out with early indications of clarifications that combine these two, actually, security side under ESMA and the payment side under the EBA.
So that's a good overview in terms of where we're looking at regulations. I'm going to come back on regulations, talk to you, the two of you, in terms of your licenses, etc. But before we go into it, it's a very good point that Benedict brings up regarding institutionals, right? Are we talking about the big asset managers? Are we talking about hedge funds? Are we talking about the sell-side banks who are buying things for their clients or the brokers? Or are we talking about just big traders who have money, individuals or companies or prop trading shops who want to buy, X number of things? So what, in your opinion, are, when you are looking at institutional, is your definition more towards the financial institutions, or is it more towards the banking? Dave and Yoni.
Sure. So we started an OTC desk about 3 years ago,
yeah,
mainly out of demand for people who wanted a very liquid professional service to either buy or sell very large amounts of crypto. And admittedly, I'll say that the demographics when we first started were either geeky high net worth individuals or early adopters who had an enormous amount of crypto to offload. And we've seen the demographics of who we service now mature, more so now that we, it's high net worth and ultra high net worth individuals, funds, family offices, asset managers, private banks. And as Benedict pointed out, there is probably a varying degree of what we call as institutional. But what I can say is that we're doing a number of proof of concepts with tier one investment banks. And it comes back to that sort of acknowledgement that this is an asset class they need to have some exposure to. And they're coming to us and saying, okay, you've managed to secure custody for the last 5 years. You've never lost a cent of customer funds. We want to know how to do that, okay? Because we are seeing demand from our own clients who want access to this space. We can either try and acqui-hire or buy a company, or we can team up with someone like yourselves to understand how we do that. And so the fact that we are doing a number of proof of concepts with tier one investment banks to understand how we custody our digital assets, and also some proof of concepts with them actually routing orders to our desk and understanding, getting used to the idea of T+0 settlement. I mean, these are challenges for the banks, given when they have, for the last 5 or 10 years, have held themselves very proud and said, oh, we can do T+2. Banks don't necessarily want instant settlement because the downstream processes don't allow it, but they're going to have to change.
Okay. Yanni, from your perspective, is it similar to what Dave's mentioned, from how you categorizing institutional?
I think we're seeing interest, but generally from our discussions, I think nobody's jumping to the water. I think asset managers or traditional asset management, I don't think has gone into crypto yet. And I don't think they're going to get into crypto right now. They are building infrastructure. So if they want to, they could, which is extremely non-trivial, by the way, from cyber risks and operational risk, etc. But what we're seeing is maybe it's more the European, Europe is relatively conservative asset management, and we still sense a lot of, I would say, cynicism around crypto, and even more self-righteousness now of, you see, it was a bubble.
Yeah. So, fair comment, right? So you have the traditional asset managers. I was speaking at a conference a few months ago. It was an asset managers conference in Hong Kong, and I spoke about crypto funds, etc. I said how many out of an audience of 200 would be looking to would be interested in potentially investing in crypto in the next 2 years. I had 3 hands go up, right? Of which one was a half hand who came and converted afterwards as to a full hand. But you didn't see too many people in public stating they want to do it, but at the back end they might have an interest. Now, in the 3 of yours experiences talking to, let's say, for the interest of this particular conversation, institutions, meaning financial institutions rather than the big individuals, what are you seeing? Why do they want to get in? Is it FOMO that they missed out? Is it because they're having huge pressure from their clients? Or is it because they see this as an emerging asset class that will last for a long time? What do you see as their main motivations? Benedict, let's start with you on that from when you're having conversations.
So I think it's very hard to generalize, and to be honest, I personally think we're in a bit of a transition mode. So maybe let me describe this. So there are funds that are solely investing in existent cryptos. So and they tend to be open for professional investors and above, including in Hong Kong. So what they do is they analyze the exact technology that these startups that have issued these coins in an ICO are trying to build, and they take a long-term view on that, on whether they think this will succeed or not. That's one strategy. There is a second, and by the way, they can operate unlicensed, provided that they limit their business to PIs and that they don't actually do general marketing. So they might not be the funds that you see on the bus. The whole point is they shouldn't be advertising on the bus under SFC rules, but they exist. The second type is the hedge fund type. So they might be actively trading on these platforms for price differentials and price arbitrages. They're relatively few, but there are some in town like that as well. And again, they are largely staying unlicensed at this time. So, and then comes, I think implicit in your question is, what about the licensed sector? So typically a licensed asset manager under their mandate is restricted from holding assets unless they are with an independent third-party custodian, or they have somehow very high kind of comfort with that custody solution. So maybe we can talk more on the custody theme, but let's say I think that the licensed firms, or you could say the world's largest asset managers, they'll be looking for independent custody solutions. And these solutions are being worked on. So to go back to my role at the GDF, we are running a working group on custody, and we have collected by now a list of custody solutions that either are already in place and that you can already look at, or that are in a state of evolution, meaning where teams have announced that they're working on something. And there is a very broad range as to how they want to achieve that safekeeping of these assets. So I think that is one way where the institutional sector, or when the institutional sector will be more comfortable to come in. But the other transition thing is the STO point, and we can discuss that more. That is tokenization of, you could say, regulated assets, securities or otherwise. Once that happens, there is nothing that should hold back a fund from investing beyond what I set out, maybe that they look for specific custody solutions that are independent and strong.
So Dave, you have, as you said, you have one of the largest OTC desks in Asia, if not globally. And so why are your clients coming in? And with the POCs that you're doing with the institutions, what is the interest? You mentioned one, which is to, because they're not proficient in this technology, they want to partner with somebody who's proficient and learn from them. That's one. But what about the buy side? What's their motivation?
I think it's twofold, Monsieur. I mean, one, it's this acknowledgement that it's not going away. And it's also, if we look what happened in the tail end of 2017 and in the start of this year, I mean, with the ICO fad, I mean, it was Kickstarter on steroids. It was literally people were just throwing everything they had at an asset class that they very much didn't understand, and everyone was drunk with the idea of having 30 times return in a few weeks. We then ended up completely hungover on misunderstanding what it is what we had purchased and why it had value. But and ICOs as a result, by being misused by some bad actors in this ecosystem, ICOs now have a really bad name. Now, regardless of your opinion on ICOs and whether or not they added some value, the reality is that there was no faster way to raise capital during this boom. It completely disrupted every venture capitalist on the planet. So we're now in a space now where people are saying, okay, I love the technology, the transparency, the smart contract ability of an ICO. I love the fact that it can be globally diverse. It can diversify my investor base. But how do I do it in a safe and regulated manner? And so this is the reason why we're seeing this emergence of this new class called security token offerings, or STOs. it is going to be an asset class which may, compete with traditional capital raising vehicles or methods. And I think, investment banks are now looking at the tokenization of commodities, securities, and so on. And again, it's that acknowledgement that this isn't going away, and potentially this asset class actually does have some cool parts about it. And what we're trying to see now is the emergence of, okay, how do I take this technology? How do I approach it? How do I regulate it? And I think the other thing, the interesting thing around this asset class is the innovation that has driven regulatory clarity. When ICOs, 2 years ago were raising billions of dollars, you had more innovative jurisdictions looking at this as a way to stimulate economic growth. Okay, if I can capture 5% of the ICO market and raise billions, well, it's going to help my economy. And so that's something that's actually quite cool about the crypto asset class. It has actually provided, and in fintech to a wider degree, it has actually made regulators, sort of look around at what their peers are doing and create competition. And for me and for everyone in this space, that's an awesome byproduct of where we've been for the last 3 or 4 years.
Your views on what your institutional clients are looking for, why they want to get into the digital asset space from a Europe perspective?
Again, what we're seeing is, first of all, most of our business is retail.
Yeah.
So we've seen sort of the retail demand slowing down gradually, and a lot of the retail sort of coming to do both stocks and crypto in eToro. I think institutional demand at this point, again, is relatively weak from the intent to invest. But everybody's preparing infrastructure in case there's another boom. And I think some macro believe that if another GFC happens, another global financial crisis happens, Bitcoin might be a very interesting potential safe haven. So I think there's that thesis, which is why everybody's preparing to make sure that they have the infrastructure to invest.
You had a little chance at the end of Q4 and beginning of this year where there was a safe haven rush to a certain, not a massive rush, but probably that still went to the traditional Japanese yen, Swiss franc kind of a story, or the US treasuries, right? Now it's a
bit dangerous that the crypto space is now starting to want a global financial crisis to accelerate Bitcoin prices.
Because
so when you have a very smart group of people who want to see the existing banking system collapse, it might become a self-fulfilling prophecy.
Yeah, but it becomes difficult if the people funding the traders, they don't have their money in the bank to be able to buy the crypto. So I think that's not being...
Mashi, just one other point about this space, why are people now involved from an institutional perspective? The space is maturing rapidly. I mean, if we look at where crypto was in the Mt. Gox days and centralized exchange failures, which admittedly still happen today when people lose money, the reality is that the space is very different. I mean, you do have regulatory clarity. Your custody services are now insured. You've got big four audit firms like PwC auditing a company like myself. I mean, it's giving an element of legitimacy and credibility for people to feel confident to actually enter this space. Whereas before, trying to deal with a centralized exchange that you don't know whether it's fractional, it's unregulated, you don't know anything about it, it's not transparent, which is ironic given everything in blockchain is meant to be transparent. It's now getting it to a point where people are comfortable dealing with counterparts like the three of ours.
Yeah, I think it's a good segue into my next question, which is actually, you spoke about infrastructure and you spoke about structure. I mean, what I mean by that is, one is the technology infrastructure that is needed to get onto the digital and the blockchain ecosystem. But the number two is structure with regards to regulatory or best practices that attract institutions, right? Custody was one major thing that we all have spoken about, and I think we all agree that there is a lot of maturity in the space and a lot more players coming in, either backed by financial institutions themselves or having some strong basis with a crypto exchange, all right? Number two is in terms of best practices. So most of the exchanges, when you talk about derivative exchanges or stock market exchanges, they have a lot of rules from, to prevent flash crashes, insider trading, market manipulation, etc., etc. But since most crypto exchanges, except maybe the ones in Japan, are not really under the regulated aspect, let's keep STOs separately, but utility tokens, you do see a lot of talk about market manipulation, wash trades, etc. You saw somebody in South Korea getting arrested partly for wash trading recently from an exchange perspective. So you in the BC Holdings have also an exchange as well. So what are you seeing in terms of progression from the best practices side to attract institutions, and have we reached, as a broader scale, a comfortable level for institutions to come in to invest based on self-regulatory aspects or self-governance of these crypto exchanges? Yeah.
From my perspective, we've been self-regulating since inception.
Yeah.
So we've acted in a manner which we thought that we would have to act if the space was regulated. And I think, as we see more regulatory clarity and this asset class does become globally regulated, we will see a lot of players that aren't able to keep up or satisfy the compliance obligations. We've built a compliance suite of tools such as market manipulation, identification, transaction monitoring, chain analysis, which are all baked into the system. And with respect to the story or the recent news earlier this week about the 2 Korean executives being jailed for 3 years for wash trading on their exchange, I'm happy to go on the record and say that 95% of exchanges are wash trading. It's just that's where the market is at right now, and it's going to stop. It's going to stop very abruptly, and I hope for those that have been doing it, they do pay the price.
As an ex-trader, one of the things I was trading derivatives, right? And one of the things you'd always look for is the paper, which is the institutional money to come in, because there's only so much you can do with the retail side of things on trading, because after a while people burn out. You need the institutional money because it's looking for longer term. So to keep volumes higher, you do need that aspect. So when you're looking at the regulatory aspect, and you're quite deep into this space, both from GDF as well as with the FinTech Association, how are you seeing this evolve? And do you see that as a satisfactory level reached from an AML perspective, from a best practices from the trading side for most of the large exchanges globally now?
So to say very similar to what Dave said is we are actually also licensed, be it in the United States and in Europe. So we don't want to engage in practices that are obviously, you would say, even though not illegal, because the sector is not regulated. So technically you could argue it's not illegal. Practices that we think are not sustainable on the long term is not what we are engaging in. So I think yesterday, Mushir, you and I, we were on a distribution list where people don't know the difference between market making and creating a false market or wash trading. And to be honest with everybody here, and to be clear, they are utterly distinct from a regulatory standpoint. Market making is actually legal, whereas creating a false market is illegal. And even if, let's say, some of this activity is not yet caught in securities regulation, it can actually be caught under fraud statutes, which is exactly what happened to the 2 individuals in Korea. I tend to agree that in order to get a stable market and a sustainable market, there needs to be discipline in it. So that is exactly to go back to what I said on the GDF. That's why we founded this global digital finance. And by the way, Circle is now a founding partner of the GDF. We founded that because we thought this sector actually needs to start self-regulating by applying higher standards. So the first code we developed is the overarching principles, which have all of this in it, including market misconduct surveillance, AML, onboarding, etc. So those are the overarching principles. By the way, they're all online at www.gdf.io. We also have principles on ICOs themselves and what should ideally at the minimum be represented in a white paper. And then we have principles for exchanges, which again have a number of these things I just set out, and also for funds, for those unregulated funds. So let's say, I think most industries, if you go back to their history, at some point they were unregulated. So at some point they had to either become regulated or enter a self-regulatory stage. This industry is unique because it's very fast and it's global. So in prior stages, local regulators could kind of intervene, and you still see Japan do that. So they created a registration system and now they're passing it to an SRO. But on global level, that's very hard to achieve. So as said, we view GDF more as a standard setter, but not an SRO, because an SRO needs actually enforcement capabilities. So anybody who's passionate about the topic and who wants to up the standards and bring this sector to a sustainable future, please do get in touch.
I think in addition, from a Hong Kong perspective, the Fintech Association of Hong Kong was one of the first in the world to issue best practices for token sales, and we issued a recent version. The idea was very much in line with what Benedict and Dave are mentioning, which is regulators need more concrete idea about technology and developments before they can bring in new regulations. But as an industry, it's upon us to ensure that we are complying whatever as much as we can with the current regulations. So the best practice was a way to show those who wanted to raise funds in a legitimate way, the practices that they could follow, and that's what we've been building and working with GDF also on that.
Actually, maybe to add one further thing is the other reason why both these efforts are very critical is because they are looked at by regulators globally. So after we issued those two documents, indeed the FinTech Association document on ICOs or token sales is 60 pages, and it's the most in-depth document of its type that exists. As said, over the same period, GDF made high-level principles. They are very complementary to each other. But the point is, regulators are actively engaged in this dialogue, and they look at these, and they reflect on it, and think about what would best fit within their regulatory regime. And towards what you said earlier on, it has led regulators to think and say, okay, are my rules actually fit for purpose, right? As you said, this is a new financing mechanism. And there are certain regulators who've made very clear statements. They will make new rules for this. New rules with the view of facilitating it, of allowing it, but of allowing it within these boundaries that we set of AML and proper conduct.
Yeah, so just very, very related to this conference, the CFD industry and FX industry started unregulated, right? So it started all basically on a loophole saying Forex isn't securities, very, very, very similar, right? So Forex, spot Forex wasn't securities, so all the online firms started initially without a license at all, right? Just, I think it was 2007, MiFID defined FX as CFDs, and therefore it became securities, and all the FX firms then had to be regulated in Europe. So very, very similar, even the same actual loophole, that spot FX wasn't securities, and this industry saw gradually what happened is it's getting regulated everywhere. It's expanding from CFDs on FX to commodities to indices to single equity stocks. So the CFD market expanded into more assets, which is, I think, what we're going to see with STOs and stable coins and other digital assets. So we're going to see the expansion of it. Second part, so again, a lot of similarities to the people sort of in this industry. Second, you see gradually, basically centralized exchanges will need to get regulated because there's a single point of failure. There's a corporation that somebody can approach that corporation, and at some point, regulators will decide to approach an entity despite the fact that it's based outside their country. Once they're regulated, the first thing is KYC and AML, right? So that's the sort of core thing. I think when Circle bought Poloniex, it took about a month for them to tell all the customers, you have to get verified or we close your accounts, right? Something like that. And that also prevents spoof trading and wash trading. Because one of the reasons you have such large amounts of fake volumes is if you can create fake accounts and nobody can trace you, and the account has no, you can actually fund the account and you can trade through that account, and you can create fake volumes between different accounts, and nobody can find out who is behind that account, then it's really easy to create those fake volumes. Once people get KYC'd, you're in a much worse position to try and do any type of spoof trading, wash trading, fake volume if everything is KYC'd, because once the regulator comes in, they ask to look at the accounts and they can finger point and see whoever's done it. So that's sort of a big tipping point is the KYC, which by the way is a process. You gradually see more and more exchanges going towards full KYC before trading.
I think that makes sense in this world, as you said. You know, blockchain, ironically, as Dave mentioned, was meant for transparency, but once you have different accounts and you use your mixers, etc., then it's difficult to trace. So this process of KYC at the wallet level is very important, and then at the exchange level. So we're getting close to the end. So what I want to ask you is, from your perspective, what are the institutions who want to come into digital assets are going to be looking for? Are they going to be keen or getting into the derivatives in the futures world, or are you going to see them still be more keen on, for lack of a better word, the spot/cash market in terms of just investing in Bitcoin, Ethereum, just the coins? Or would we see them being more keen on the IPO process, meaning the ICO and the STO processes? So where do you see the institution's interest for 2019? Let's just keep that for 2019. I think in this industry, jumping 2-3 years ahead is maybe a big folly. So for 2019, where do you see institutions having interest? In derivatives, spot, futures, or are you looking at ICOs or STOs?
I think for people from the crypto industry, it seems very ironic, but I think for financial institutions, derivatives is actually a better financial product that they can sort of understand and manage versus holding real crypto assets. So if you're a financial institution, investing in a derivative like an NDF is a financial instrument. You're investing in a financial instrument, you understand regulatory, how that financial instrument works, and you have another counterparty where you bought that financial instrument from. Versus holding crypto assets. When I talk to financial institutions, like again, the more traditional ones, actually holding private keys and taking that cyber risk, I don't see that happening.
What about through custodians on that case?
Again, for financial institutions, and that's why you have the CBOE and the CME and now BACT and other ones, I think more traditional financial institutions will actually find it easier and simpler to use derivatives than to use spot.
Yeah,
okay.
I tend to agree. I mean, for us, it's a number of things. It's that level of comfort that I talked about in terms of who's your counterparty, what credit risk am I going to have with this entity, who are they, where are they based, are they regulated, what's their backing, are they financially stable, etc. But when we speak to our counterparts, one of the things that we're looking at now is actually moving into derivatives, into options, repo with borrowing and lending, synthetics. And it's, as Yoni said, there's one thing holding the physical, and then there's another element for traditional finance have been using these instruments for as long as we can remember, and it's what they're used to. So I do agree, and that's the direction that OSL is undertaking right now.
Benedict, from a Circle perspective, where do you see this?
I'm not sure I have that crystal ball, to be honest with you. I think, in fact, we are still seeing interest in all different angles of this. So I think it's difficult to point one out. I think, in fact, the next year may show that it squeezes more to one than the other. But I think right now it's really in all three. But one thing I would add, though, is that what we haven't spent a lot of time here on the panel is what really are these coins representing, right? So we've been talking about trading them, we've been talking about investment and all of that, but we haven't been talking about what do they do. And I think the key point is that there is about more than 2,000 of them out there. Secondly, there are some that are known to be, let's say, fraudulent or are not really working on projects. But on the other hand, there are a lot as well who continue to invest the money that they have raised to try and develop de facto technology with a specific focus on Web3, which is specifically the original purpose of Bitcoin, which is the decentralized internet de facto, right? Where individuals can interact in a decentralized fashion, and to which the smart contract piece added by Ether is still a very key part. So I think there has to be continued focus on that as well, and maybe we will see more people take, for example, even equity interests in some of the projects that are starting to see significant adoption. Or to the extent these projects, as say, remain in the unregulated space, again, there could be interest in investing in these. And of course, when STOs come around, if there are funds that say, look, I want to hold this in tokenized format, then definitely there will be interest for that.
Yeah, I'll use my crystal ball. But I think we're definitely going to be seeing the rise of stable coins, or the continued rise of stable coins, fiat token, and digitization of assets. We're going to see that scaling in 2019. And I think what's really interesting, and not a lot of people are talking about it, is smart contracts are a great way for financial contracts. But stable coins, basically, once you have digital assets like regular financial assets on the blockchain as ERC20 tokens, then you can actually do really cool stuff with smart contracts between counterparties. Until now, you can't do it because you don't have assets to actually write smart contract code to trade with.
So to close, and you need to be clear, pick one region or country where you think will be the most interest for institutional investment into digital assets. One, right? So let's take your pick. We'll start with Yuri.
What? Choosing one country, not China?
One country. Well, it's the affirmative rather than the opposite. One country you think will be, in this year, will be leading the interest from institutional?
We're seeing, again, it's not one, but we're seeing US, Japan, and Korea sort of leading the institutional, more mature space. Japan by far. So if one, Japan.
Okay. Dave, you're close to Japan, but
is Asia a country? Because
No.
that would be my answer. We're working with regulators, all within Asia, and the conversations we're having are very positive. I would probably say definitely Japan. Korea is probably 2 years away from regulation from when I just visited there and speaking to our counterparts. So I probably wouldn't say Korea. And I'm a very proud Hong Kong permanent resident, so I'm going to have to say Hong Kong.
yeah, okay. Benedict, for you?
Same answer as Dave. I think it's very difficult to pick a country, but definitely Asia has the demographics that are much more interested in technology, in automation, etc., and in being early adopters, more risk-taking, I think, than maybe the other parts of the world. So definitely Asia.
Thank you very much. Is there time for Q&A or there's no?
Yeah.
Okay.
Not only time, it has already been done. So
Okay.
we have several questions. Let's turn on the Slido, please. We have several questions. You can see them the moment that you can actually see them.
You can just
Yes.
see the back of our heads doing like
Yes,
this.
yes, I know. There's
we
a
go.
delay. Okay, here we are.
Okay,
So why doesn't the HK regulator do more to kick out? Okay.
Ethical. Crypto OTC became somewhat established with which. So let's go with the third question because it's directed towards Yoni, which is will
Yes.
eToro offer leverage margin trading to users? What do you think about these products? I think this also ties into what we're seeing with question one, but yeah.
Right. So eToro has always been a regulated brokerage, and in our regulated brokerage services, we offer leverage and margin trading, and we offer it both on stocks, CFDs, and crypto. I think the unregulated exchanges are enjoying right now some regulatory, not sort of arbitrage or loophole, but eventually that will probably close. And eventually there's a lot of trust needed in finance. So I think eventually, again, centralized services are going to be regulated.
And as the other question is on potential Hong Kong regulatory action on supposedly illegal or unethical exchanges and derivatives exchanges. I don't think we're going to take names here, but do you have any views on that, which is what the regulator is doing to protect retail investors from derivative exchanges?
Well, I'd say two things. First of all, let's say the definition of securities is set out in the SFO. So I think the word illegal there might not be correct. Secondly, as well, in terms of where it might go in the future, I think it's a bit hard to tell. But interestingly, in Hong Kong, what a lot of people forget is that there is actually a listed market that is highly speculative as well, which is the CBBC market, the warrants market. So it's hard to say that it's, let's say, all too far away from that in a sense. So there is precedent for let's say, listed markets accessible by retail that are quite speculative as well.
Okay.
Sure. I think there was a question there about OSL. Why are we not more transparent with our block trades? I'd say first and foremost because we preserve the privacy of our counterparts. At the end of the day, one of the great things about blockchain is that it is transparent. It's not particularly difficult to actually find out, the transactions or the trades that we're doing. And using recent chain analysis tools, you could probably even identify some of the counterparts. So, in terms of, we have had discussions with other OTC desks such as Circle and Cumberland and other big players as to whether or not we do want a consolidated or a trade feed that is published. For now, there is actually an ongoing regime for some of those organisations I've talked about that are going to offer such. For us at OSL, preserving our counterparts' privacy is probably first and foremost more important, but it's something that we'd definitely consider in the future. There was something else saying something along the lines of that we're working with unregulated exchanges. Given where crypto is right now, there wouldn't be too many counterparts that we would be dealing with if we weren't dealing with unregulated exchanges. But we continually review the venues and the market participants we deal with, and we have probably one of the most stringent compliant and counterpart policies. So it's always a balancing act between security, compliance, who we want to deal with. At the end of the day, we don't deal with unverified or incompliant businesses, and that's something that we pride ourselves on. The other question there that I saw that piqued my interest was, where do I see the OTC market going? I mean, the OTC market really started a few years ago because of the fragmented liquidity that was around on various venues. We have to remember that this market cap for the total crypto asset class is tiny. We were peaking at around $700 billion at the end of 2017, start of 2018. We had this enormous correction. If you take out, the top 10 market cap tokens or coins, you're looking at a $100 billion market cap. This industry is absolutely tiny. Bitcoin only transacted $2.2 trillion last year. That being said, I'm very bullish for Bitcoin. I'm very bullish for the blockchain. And the reason why I am so bullish is, this is a technology that is intended to provide greater transparency for financial transactions. It's intended for giving power to the people to manage their own money. It's also, Bitcoin is the one technology in the world that could potentially provide financial inclusion to the two-thirds of the world's population that don't have access to bank accounts. So if we think that there is a chance that it might actually work, at the very least, it could completely, or at the very most, it could completely disrupt finance as we know it. And at the very least, it could help provide, keep financial institutions more honest, given that there is now an alternative to our traditional financial institutions that we've seen continual failures over the last 20 years.
So last words, Benedict.
Yeah, maybe just on fiat tokens. So what fiat tokens are is de facto it's a coin that is linked one-for-one to a reserve in that fiat. Fiat, for example, being US dollars held with a regulated institution. That's what form it could take. Now, the advantage of it is that indeed you could, in the long term, see it being used for actual spending and payment. Short term, we're not there yet, but long term, that's the direction. It is different from your current Alipay or WeChat Pay because they're not interoperable. So that's the point. They're closed loop systems still, whereas this system is open. That's the key difference.
Thank you. Thank you so much, the three of you, for your wonderful views on topics and being brave enough to answer controversial topics. I think what we learned from the panel in particular for me is that the technology is a key element of where we're going. As we see maturity in the technology, there'll be more interest in terms of how the maturity happens. And secondly is regulations. As we see more regulations, both self-regulations as well as key regulators coming in with guidelines, you will see more institutional flow coming in. And in the future, it's a matter of this being another asset class that they invest in. Whether this will be a dominant asset class in the future is yet, the jury's still out there, and probably in 2-3 years' time, we'll have a clearer picture once we start seeing the paper come in to crypto trading in a major space. So thank you everyone for listening in, and I want to thank the organizers for having us here today. Thank you.